A step back from the brink, President Trump signaling today he may take a less confrontational approach towards curbing Chinese investment in sensitive U.S. industries. The president denied reports the administration would curb Chinese investments by invoking an economic emergency, instead saying a lot could be done through the Committee on Foreign Investment, CFIUS. While the president considers which tools in the U.S. arsenal to use in his trade spat with China, our next guest has considered what China could use besides tariffs to respond. For more on that, we welcome now Brad Setser, Senior Fellow on the Council of Foreign Relations. Brad, great to have you with us. So talk us through the options here, because clearly it's not just ramping up tariffs in response alone.
So broadly speaking, China has three asymmetric options that don't involve responding to $1 billion of tariffs that the U.S. imposes with $1 billion in Chinese tariffs. One is to get tough on U.S. companies operating in China, make it hard for Starbucks to sign a lease, mount a campaign against GM to reduce its joint venture sales. The second is to guide China's own currency down. If the U.S. is taking actions that reduce China's exports, one logical response is for China to take actions that would boost its exports, and a weaker currency would help there. And then the third, which gets a lot of attention, is often discussed, is China could try to use its large holdings of U.S. bonds, primarily treasuries, but also some agencies, as a tool of influence. My personal view is that that's actually kind of hard.
Brad, explain why that is, because people often cite that one, but it basically just contradicts point number two. There's no way to really reduce its holdings if it also would like to have a more competitive currency.
Well, I'll push back a tiny bit on the contradiction. China could shift from longer dated treasury notes, so 3-year, 5-year, 7-year, 10-year bonds, to short dated treasuries, bills, or put his money in bank accounts. That would have no currency effect, but it arguably would have some effect on the shape of the yield curve. The difficulty is that if China's moving the yield curve around, if China's pushing up the term premia, the Fed could quite logically respond by shifting its policy path, or even by signaling that it would adjust the pace of balance sheet roll-off. And in broad terms, that has the exact same but offsetting effect of Chinese sales of longer dated bonds.
And Brad, at the same time, we are starting to see signs that Chinese growth is weakening. Does that then further limit some of those arrows in the quiver, so to speak, that you were talking about?
Well, I don't think it materially affects whether or not China is going to, kind of at the margin put pressure on Starbucks. You could probably do that without having a material impact on Chinese growth. It could actually constrain China's ability to respond dollar for dollar with tariffs, since many of the tariffs, particularly as you go to tariffing essentially all of U.S.-Chinese trade, would have an adverse effect on Chinese economy. If you put tariffs on imported U.S. semiconductors, for example, that would hurt China's exports. The option that would, in some sense, hurt the U.S. and help China, particularly if China's economy is slowing, is a weaker currency. And that's kind of obviously what the market is now focused on.
Yeah, and clearly we're already seeing that, and we've seen the fixings as well from China weaken too. But how much latitude actually do they have here to weaken the currency without creating broader concern from investors actually that we're going to see a broader depreciation and kind of forcing it and risking capital outflow as a result?
Well, I think there's two interesting points to make here. One is that by signaling that it wants a slight weakening of its currency, China could trigger, as you mentioned, more outflows. That has some risk to China, but it also would give China the appearance that a Chinese currency depreciation is in response to market moves. So that might ironically have some positive effects on the optic side. The harder question, though, is once you put that in motion, how do you keep it controlled? China historically has not wanted an uncontrolled depreciation. So in the event that the currency weakens, and there's expectations the currency would weaken more, there would be a risk that the outflows could become too big and that would test China's tightened capital controls. My personal view is that China probably has a little bit of latitude here, that given that the controls were tightened significantly in 2017, I think China could manage, but there's clearly a risk.
So just to be clear, I mean, the conventional view, I think, is that the currency devaluation of 2% in August 2015 was not a particularly successful or well-executed policy that did spur a lot of nervousness, a lot of market volatility. You think they could kind of go back at it, but maybe in a smarter way that doesn't cause as many problems?
Well, I think there's a couple of questions. One, does it cause a lot of volatility in China that China doesn't want? Weakening of China's own stock exchange and the like. The other is, does it cause volatility globally, particularly in the U.S.? And in a trade war context, that volatility in the U.S. in some sense is the desired outcome. I do think there, though, are a couple of important differences between China's position now and its position back in 2015. The first is that the carry trade, which was quite strong and had led to a big run-up of short-term Chinese debt that Chinese companies owed to banks abroad, that carry trade unwound in 15 and 16, and it hasn't come back with the same strength. So the fuel that drove some of the market volatility isn't there. The second is that China really did tighten its controls in 2017. That's why FDI outflows fell off a cliff. And so there's arguably less scope for money to move out of China then than now. And the third, and this is a little bit more debatable, is that China has, in the 2015-16 move, broadly transitioned away from a peg against the dollar to a peg against a basket. That doesn't mean that you can devalue against the basket without having any consequence. So I don't think that's decisive. But I do think that there are a set of differences that might allow China a bit more latitude.
So, Brad, taking a step back and looking at the whole situation here, on balance, when you look at these various options open to China, and on the other hand, when you look at President Trump's seeming willingness to incur and live with some negative, at least short-term consequences, where does the balance lie at this point? Who has the benefit in leverage at this point?
I mean, I honestly think it's pretty balanced. The U.S. imports more, and therefore the U.S. has more scope to put tariffs on Chinese goods than China does to put tariffs on U.S. goods. That's sort of the reality that Trump keeps coming back to. Exports to the U.S. are more important to the Chinese economy than U.S. exports to China are to the U.S. economy. That said, the U.S. has more direct investment in China than China has here, so China has more opportunities to squeeze important U.S. companies, and China has much greater scope to use its currency as a policy tool than the U.S. does. We treat the dollar as the residual after monetary policy decisions are changed. China's currency is managed.
Brad, real quickly on the, we didn't dive much into what it could do against U.S. companies directly, like Starbucks, like Apple, like GM. How much of a possibility do you think that really is? And is that something perhaps that in the discussion we have about retaliation isn't getting enough attention and perhaps maybe not being thought about enough by investors in some multinationals?
No, I think it's gotten a reasonable amount of attention. I think there's sometimes actually a tendency to equate damage to U.S. companies and their Chinese operations with damage to the U.S. economy. So I would agree with you to the extent that it is focused on what matters to equity investors rather than it is focused on what matters to the broader U.S. economy. But there's plenty of examples of China mounting powerful campaigns against foreign companies operating in China. If you look at how China responded when the Koreans allowed the THAAD missile defense to be based in China as part of the attempt to counter North Korean missile developments, and the Chinese were upset, you saw a really quite sharp drop in Hyundai's sales inside China. Its Beijing joint venture partner started complaining that Hyundai's joint venture was spending too much on imported Korean parts and not buying enough low-cost Chinese parts. And you saw a fall in Chinese tourism to Korea as Chinese tour companies stop marketing trips to Korea. You can just kind of go through the list. And because of the nature of China's economy, there are a lot of informal levers that China could apply. Obviously, you take the Hyundai playbook and apply it to GM. You can make it hard for Starbucks to get a lease. You can start mounting campaigns that suggest drinking coffee is unpatriotic and that people in China should be drinking tea.
Wow.
The options are pretty broad.
We do not talk about this enough. The joint ventures and the services angle here is critical.
Yeah. Well, luckily, Brad brings it to our attention. Brad Setser, Senior Fellow at the Council on Foreign Relations from Washington. You can read his full blog on what would happen if China started selling off its treasury portfolio at CFR.org.